Welcome to This Week in Local, a Locology podcast featuring lively conversations about the local digital ecosystem, hosted by Locology analysts Mike Boland and Charles Laughlin.
Hello, everyone, and welcome to This Week in Local. I'm Mike Boland, joined by my co-host Charles Laughlin. Hey, Charlie, how's it going?
Mike, it's going well. Yourself?
I'm doing well. So I'm curious to hear what you're looking at and working on this week.
Well, it's something I think both of us have been looking at and looked at recently, which is sort of what's going on with venture funding. I know that's incredibly broad, but what I was looking at just before we got on, to be honest with you, is, and it's something I'm writing about once we're off this recording, is something from CB Insights, which kind of looked at Q2 global venture funding, which was, I think, up about 6% quarter over quarter. It's about 66 billion in venture funding in Q2 2024. So it's up a little bit. The general take of CB Insights was that, there's still a lot of caution, skepticism, the sort of funding winter that makes me cringe a little, that cliche, but it's not quite summer yet, but it's certainly thawing, it seems anyway. But there's still some chilliness out there, I guess. But what was interesting in the numbers, one of the interesting things was that of that 66 billion, about 18.3 billion, which is about a third, 30%, a little under 30%, I think, was going to AI startups. Mm-hmm. Big surprise there, of course. But what, it sort of raised the question in my mind is, can you make the statement that AI is propping up venture funding? Maybe. If AI was not hot right now, would venture funding be in the dumper, or would just some other, nature abhors a vacuum sort of thing? Would some other sector rise to fill that vacuum? Is there a natural vacuum based on the timing of the market, for example, going on right now, that something has to fill? Maybe, maybe not. But what's interesting is that, that 18 plus billion going to AI in just one quarter kind of touches on things we've been talking about sort of on an ongoing basis. I think on a recent pod we talked about, I raised I think it was Ario, is this company we talked about a little bit, that was doing AI personal assistance, and we had a little fun with that, but that led into a conversation about what is a real AI startup, what's getting funding, what's legit, what's just, a garbage AI startup. And that kind of reminded me of the Q&A I had on stage at our L24 conference with David Shim from Read AI, who raised, I forget if it was 15 or 16 billion Series A, something in that range. Million. Sorry, he's not that big. Love David, but he's not that big. Very few companies are. And he said something super interesting during that interview, which was, yes, there's a lot of AI startups out there, but the venture capitalists are extremely skeptical of them, and they're being gone over with a fine-tooth comb. It wasn't his exact words, but essentially what he said is, they're lifting up every rock when it comes to AI startups, because there's a bit of suspicion of AI startups, even though there's obviously eagerness to fund them, as these numbers suggest. So I don't know exactly what's going on here, and I know you've looked at some of this too, so I don't know what your sense is.
Yeah, so I go back to the question you asked of, is AI sort of propping up venture funding? And I think it could go both ways, because one, the AI funding rounds, when they do happen, you're right that there's a lot of scrutiny, because VCs are trying to not get caught up in things that are just sort of like a thin layer of AI. Like when you have deep tech, when you have AI deep tech, those fewer numbers of deals get larger valuation. Right. So I think that the numbers are being skewed by those companies simply because a lot of these deep tech AI startups require more money. So they're getting
they
more
did also say in this
round.
data that the average deal size is growing.
Yeah.
So
that's pushing up the numbers. But on the other hand, you mentioned if there was no AI, would this money still be going somewhere? And I think the answer to that has to be, at least to some degree, yes, because, managing partners are under a lot of pressure to deploy the capital that they're getting from their LPs. They can't just sort of hang on to it and not do anything, because it's, when it's sitting on the sideline, we're talking about many billions of dollars that are just sort of in a cash account, and no one wants that. So it has to be deployed.
No one will earn 3% or whatever.
Yeah. So there's got to be like sort of the vacuum will get filled, to use the word, to some extent. I think it's a little bit of both. But this is interesting too, because this aligns with some data that I saw, and I wrote an article last week about this, where I think it was PitchBook. They said that the valuations, the average valuation of just companies getting funded, is back to like pre-slump levels. So back to like, I think they said pre-Q1 2022, which was essentially like the COVID software boom and SaaS and all of that, when those valuations were just going nuts. We're actually back to that. But, and at first it's just like, whoa, really? Like that's a great positive indicator. But then you stop and think about it. And the catch there is there are a lot fewer deals. So that doesn't indicate the sort of the health of or the robustness of the frothy VC funding environment, because there are many fewer deals. And those deals, that average deal size, the reason the valuations are high, are being skewed for the same reason I mentioned earlier, which is a large share of these are deep tech AI startups that need a lot of money. So at the end of the day, it is the same pool of money being distributed more or less, but it is larger rounds going to much fewer companies is I guess the simple way to say it.
And I think that gets to something we talked about previously, which is the capital intensivity of true AI startups, like you said, the ones employing deep tech rather than ones just slapping a layer on top of
it's expensive.
GPT, right? Yeah, I mean, I was just poking around before we got on and saw something. I think it was from Crunchbase saying that, last week's biggest rounds. Notice two things. One, the size of the rounds was, of course, big because it was a list of the biggest. The top one was 300 million to a company building robotic brains. God only knows, what that will lead us to. But so there's a massive rounds. But the other thing I noticed, maybe a little semantic, is that they don't really seem to be treating AI as a category. AI is sort of what's underneath, whether it's an educational or a robotics or a something, but it's AI underneath it. So is AI a category, or is it what defines a startup that's in a different category, like FinTech, et cetera? Maybe unimportant, but I sort of noticed that they weren't really calling these AI companies. They're calling them a robotics company or something else that happened to be, AI heavy. And maybe it's becoming sort of like, remember when Mark Andreessen said software will eat the world?
AI is going to eat, think about Microsoft. Microsoft is not an AI company, but they have AI like infused throughout everything now. So it's sort of like it's going to be part of everything. So I think that's right. At one
point they said every company will be a software company. Every company will be an AI company, but
it's like mobile. It's like mobile too. Remember, like we used to run conference sessions and we would say, this session's about mobile. Like no one does that anymore because it's just sort of infused everywhere. So it's sort of like that. Now, another thing to point back to in the PitchBook data, I mentioned like, hey, good news. It's, average valuations are up. But the bad news is fewer rounds, skewed by AI, et cetera. There's another angle to that too that shines an even more daunting light on the market, which is that the PitchBook data in coming up with those larger valuations did not factor in things like, startups that took unpriced rounds through convertible notes or insider rounds or delayed raising capital because they didn't want to face a down round, or simply those that like died because they were unable to rise their next round. So like there's a lot of that going on that isn't like factored in.
Really captured very well.
Now that's the bad news. The good news is sort of a silver lining on all this data when I was looking at it is that it's not just AI. I mean, like you mentioned, it's weighted towards AI, but there's still a lot of other stuff going on. And we're seeing a return to a lot of sort of something that had been depressed, which is SaaS-based FinTech, because we're seeing some large rounds, go to companies that were able to buckle down and appease investors with the sort of new criteria they're looking for, which is back to fundamentals, operational prudency, all that good stuff. And we're seeing a lot of that. And that floats down to the bottom line. It appeases investors. And we're seeing sort of a return of a lot of fintech companies and, healthy funding rounds based on those that were able to sort of turn themselves around from the, free for all, freewheeling spending era of the COVID boom.
So, the thought that just popped into your head isn't always a good thought, but the thought that just popped into my head is what you just said in any way related to what we've seen over the last year or two, really, of all the tech layoffs.
Yeah, layoffs are part of it. Unfortunately, that's the ugly truth. Yeah, I mean, that's one of the biggest things on a P&L. In the L column or the L section. So
that was occurring in order to make what you just said happen.
Yeah,
partly.
Oh yeah, that's to get to that point of operational prudency.
We cut costs. We were managing. Yep. We were running it like an adult, and please give us more money now.
Yep.
Probably not that simple, but
we've been good little boys and girls. So can we have our lollipop now?
Can we have our round now, please? Yeah. Maybe so. Okay, Mike, why don't we end it there?
Yeah, sure. So thanks, Charlie. Thanks, everyone, for listening. This has been This Week in Local. Stay tuned every week for more episodes. You can find the show on all major podcast networks and find out more at locology.com. So please subscribe, like, and comment. Your engagement helps others find us. And if you're interested in being a guest or sponsor, you can email us at podcast@locology.com. So I'm Mike Boland with Charles Laughlin. Our producer is Dara Sweat. So thanks for listening and see you next time.
Thank you for tuning in to this week's episode of Locology's This Week in Local with Mike Boland and Charles Laughlin. Be sure to subscribe for more.